All right, everyone, welcome back to another episode of Everything Business, right? And in this video, we are going to be looking at partnership accounts, right? So, I was asked to, do a recap about partnership accounts, and so this is what we're going to be doing. Please remember to like, subscribe, share, right? I need the subscription, I need a like, and I need a comment, all right, to help push the video forward and to push the channel forward. All right, thank you so much. All right, let's get right into it. So, partnership account, right? Or partnership accounting. So, what is a partnership? We have to look at the basics. So, the partnership is really, right, when two or more persons decide to start and operate a business. So, any business situation where you find two or more persons, right, deciding to start the business, right, or operate the business, then that is what we call a partnership business. All right. Yeah. So let's move on. Some basic concepts or rules about partnership that you need to know if you are going to do partnership accounting is that the partners must sign an agreement when they are entering into the business together, right? This agreement is what we call the partnership deed, or sometimes it is just referred to as a deed, right? So the deed will determine how the partners operate within the business. If the partners don't sign a deed, and this is where it becomes very important. If the partners don't sign a deed, then profit and losses must be shared equally, right? No salary must be paid to the partners, right? There should be no interest on paid on capital, and there should be no interest charged on drawings, right? So these are very important because sometimes in questions they will say there was no deed signed, or they will say these are the conditions as stipulated by the partnership deed. So you need to understand that concept. Now, one account that is important in partnership accounting is what we call the appropriation account. Now, the appropriation account, all it simply means is it shows how the profit and losses and other things are shared up in the business or in the partnership. That is why you have the word appropriation, which comes from the word appropriate, which literally means to share. Now, this is how the appropriation account looks. If you are going to be asked a partnership question in the exam, in the CSEC exam, you are going to be asked about an appropriation account, or you're going to be asked to do an appropriation account, or you're going to get an incompleted appropriation account that you'll have to fill out, right? Now, I want you to pay keen attention to this. So the appropriation account, it begins with net profit, because in the partnership account, the partnership accounting business will have, or they will maintain, a pretty similar set of final accounts like what a sole trader would have. So their income statement is going to look identical to that of a sole trader, right? Their balance sheet, right, will also look almost identical. All right. However, when you reach to the profit part, that is where the appropriation account will come in, because now you're going to have to share this profit, right? So this is where the appropriation account comes in. So you start with your net profit, right? So instead of double lining your net profit, you would just start the appropriation account here. So you add interest and drawings, right? And in this example, I have two persons in the business, A and B, right? So the question will tell you what the interest and drawings is, right? So either you will get a percentage that you'll have to calculate it based on the drawings figure, or they will just give you the information. All right. So you put the figures here. These X's would represent my figures or my numbers. You add them, right? And then you add it to the net profit to get this figure. Now, there are times when a person or a partner may work in the business, and if a partner works in the business, you call them an active partner, right? For POB students, right? They would receive a salary. You have to subtract the salary from the profit, right? You have to subtract the salary, and you have to subtract what is called interest on capital. Interest is paid on capital to encourage partners to want to invest more money in the business. And conversely, interest is charged on drawings to discourage partners from taking money out of the business. All right? So, less interest on capital. So, all of these figures must be subtracted from this new adjusted profit figure. Salary, interest on capital for both parties. So you add them up in this first column, and you put the final figure there, which you subtract now from the adjusted net profit figure to get this figure right here, the bold figure right here, that is what we call the balance of profits. It is this figure that we are going to be sharing up now. So we have share of profits. Now for the partnership appropriation account, it is very important that you understand that this is where it can get very difficult. When they're asking you to share the profit or to appropriate the profit, right? Now they can ask you, they can give you various scenarios. And I just put some here to just help you to understand that, hey, this is how it can look. So they can give you the share of profit in terms of a percentage. So they might say A must get 50%, B must get 50%, or A must get 25% and B must get 75%, or whatever. They can use a percentage, right, as the profit sharing ratio. Also, they can use fractions. So 50% will be represented as a fraction. It could be 1/2, 2/4, 4/8, and so on and so forth, a fraction. They can also use ratio they can just give you a ratio for you to share up the profits. So in this case, it would be 1:1, right? Or, whatever the case might be, 1:2, whatever, right? And they can also give it to you as a percentage of capital invested, right? That way, you'd have to calculate the percentage on the capital that is invested, and you use that as profit sharing ratio, right? But you don't have to worry about that as yet. You worry about what is before you, right? So I don't want you to worry about it. We are going to practice. So you calculate the partner's share of profits, and when you calculate the share of profits, you are supposed to end up with this figure here, because you're sharing up this figure. So you're going to share it, and then this figure would be a total of these two figures, which would be the same as this figure. But that's basically the appropriation account. Very simple, very easy. We're going to practice, don't worry. But we can't move on just yet. There is another account that we have to talk about when we are talking about partnership accounting. We have to talk about what is called the current account. Now, the current account, it simply shows each partner's day-to-day dealings with the partnership, right? It basically shows each partner's financial standing in the partnership. So it basically has their personal account, right? The current account should always carry a credit balance, right? And this indicates that the partnership owes the partner, which is really a good thing. That is the way it's supposed to be. The current account is a revenue account to the partners, right? So if the account though does not have a credit balance, then it could mean that the partner owed the business money, right? Which is not a good thing, and it could be as a result of the partner withdrawing too much money from the business, and that is the reason why they would have interest charge on drawings, because partners sometimes tend to want to withdraw too much money from the business, and that put the business in a bad situation where the partner now owe the business, which it should not be that case. The business should owe the partner money, right? So it is important that you understand these details and these theory. So look at the current account format. Now, this is what we call the columnar form, where I put both partners in one sheet, right? So if you have 3 partners or 4 partners, you could put them in one sheet. They call it the columnar format. All right. There is the horizontal format, which does it individually, like a T account. All right. Most times in the exam, they ask for this format. The concept is really the same, whichever format you use. So it is important for you to understand that in the current account is similar, right? Similar to like a creditors account or a capital account. There are times when they will ask you about the capital account. And if they ask you for the capital account separate, you will just draw the capital account separate, showing the information pertaining to capital. However, this is what technically we would call a fluctuating capital current account, right? And the reason why we call it a fluctuating capital is because capital is included. If it was a fixed capital current account, then you would have the capital account separate. It would not be in this current account, and then everything else would remain the same without the capital. All right, but this is generally how it will look. Now you will realize that I have 2 balance brought downs. One is in green, one is in red, and the reason for that is because the norm for the current account is for the balance brought down to be on the credit side. As I said before, this account carries a credit balance. So if the balance brought down is on the credit side, it means that the balance carried down is going to be on the debit side. That is the norm. That is why it is in green. Now if you look on the debit side, you have the balance brought down in red. right? That is not how it is supposed to be. The norm where the balance brought down is in green, it would signify that the business owe the partners money, which is how it should be, right? However, on the debit side, where you find the balance brought down in red, it would mean that the partners owe the business money, which is not the way it's supposed to be. And it could mean that the partners withdraw too much money from the business. As a result, they now owe the business money, right? So if you look on the credit side, you will find capital, interest on capital, salary, and share of profits. These are the common items that are normally on the credit side. The theory behind that is whatever it is that increases your capital, you credit, right? On the debit side, whatever item that decreases your capital, you will debit it because this is a revenue account, right? To the partners, and the liabilities account to the business, right? So the drawings account, drawings would be on the debit side here, interest on drawings, right? You just need to remember that. And you have your balance carried down, right? And then, you know, you balance of the account, just like a normal double entry account or a cash, all right? But that's basically it for the current account format. So let's practice. So join me in the next video where I will be practicing some questions. Let me know what you think about this, and let me know if you want me to send this PowerPoint to you. I can do that as well. All right. Thank you so much. See you in the next video.